Hello everyone, how's it going? In this video, we're going to talk about S&P 500 ETF trading under the ticker symbol SPY. The market has been going through huge volatilities lately, and the most symbolic and significant exchanges in the world, S&P 500 has been one of those with a lot of focus from the public. We might be at a key pivot point with the market, and where S&P 500 will go next is a very important sign for the valuation of equities around the world. In today's video, we will talk about the price actions, long-term tendencies, statistics, and trading strategy for SPY. Before we begin today's video, I'd just like to make a brief disclaimer. My videos cover my opinion on the current events and what's likely going to happen in the future. They're not investment advice and should be watched for entertainment purposes. No one can predict the future with certainty, just our best guess. So they're prepared either before the uploading or just a few days before they were released on YouTube. Some of them no longer correspond to the latest price actions by the time you see them. Nevertheless, they're still relevant to analyze the subsequent price tendencies and to improve on the decision making. Also, the videos aim to cover the securities as broadly as possible by covering the fundamental and technical aspects. Other than the price actions and the latest news, the long-term tendencies, the shareholder composition when we're talking about stocks, the fundamentals, or other like long-term trends, if you will also be covered, as they all affect the decisions about if you should buy a specific security. So with all that being said, let's jump into today's topic. Currently, the share price of SPY is hovering around $380 level, showing a slowdown in the sell-off but not putting a stop to it. What this means is probably a mitigated picture of the stakeholders regarding the state of the global economy in the year, or perhaps in the decade to come. We are certainly at the beginning of something and not at the end. The general consensus is that, going downward is going to be choppy for sure, but almost unavoidable, given the alignment of planets against the narrative for a prosperous economy on a global scale. However, it'll be hedged by the capital flight from abroad to the American exchanges looking for a safe haven for the capital. It might also be slowed down by significant advances in specific fields like methods to generate energy, new generation of microchips capable of speeding up things, or the return to lower interest rates as conflicts come to an end, prompting oil price and anything that's related to the consumer goods price back to where things were previously. So when we look at the S&P 500 in the long term, there is a clear uptrend in the price evolution, with an obvious acceleration over the past decade or so. This event has been triggered by the increase of money supply circulating around the world in a low-interest environment, forcing capital to obtain an ever-decreasing yield instead of earning nil or even negative interest rates in savings account. The demand for securities therefore increased back then, propping up their prices. This growth provided a lot of wealth to those who decided to put in their money into equities. But now I think the things have changed. The long-term tendencies in the index price levels depends on the quantity of money around the world and the yields of the alternative investment options, and the state of the global economy as well. For the time being, all three factors are under duress. The quantitative easings have mostly ended, and for the economies that are still printing money, the newly minted capital is not able to flow into the financial systems, at least the international one. The yields for bonds and commercial paper have increased drastically, encouraging people to play it safe in those uncertain times. So, pulling capital away from equities and into the savings accounts, the investment certificates or commercial papers, or just corporate bonds. This means that overall there will be less money in the pool to buy corporate shares. At the same time, the global economy also seems to be in a rough shape. The fears for recession have been present since the end of 2019, as the bull market has been going on for long enough with a significant amount of bubbles floating around. Going forward, we're likely going to enter in a period of confusion with significant downward pressure for the market. Some of those bubbles are going to be painful to pop because a significant portion of the tech industry has been fueled by investment capital without actual capacity to earn a profit for their operations. Some of them will never be able to do this. So growth has been the keyword over the past decade or so, without serious considerations for profitability. At the same time, we are in an era of disruption, or creative fire might burn quite a few logs before giving any sparkle of actual progress. The Standard & Poor's 500, more commonly called S&P 500, is an equity index that tracks the 500 largest market caps in the United States. It is usually the most followed index for traders and investors around the world for their investment decision-making. Ever since its inception, the equities listed on the index provide, on an average, about 12% of return per annum. Because it lists the largest US corporations, or at least corporations that are listed in the United States, whether they have operations there is another story. So it provides an overview of the global financial market that is listed in the United States, as well as the overall economic health from a very high level. The components of the exchange are updated on a quarterly basis, meaning they provide frequent updates to investors about the state of their investment. So, despite its significance and the frequency to be quoted, it's worth noting that S&P 500 also has a few disadvantages. It covers equities and not other kinds of instruments like bonds, certificates, natural resources, and private equity. It's also very US-centered, so it might provide a different snapshot of how the economy is doing in other regions of the world. We also have to remember that equities are usually influenced by the offer and demand of capital, which might be affected by the fundamental and speculative reasons. For instance, the stock market might be very bullish because there is a hyperinflation in the local economy, not always because companies are necessarily doing well. Another element that might affect the S&P 500 is the direction of the international capital flow, whether they tend to go from foreign jurisdictions to US or the other way around. In a way, the securities listed on S&P 500 provide a picture in broad brushes about the state of the global economy, the size of asset bubble or deflations, as well as the market's confidence in the market. In the long run, the S&P will be able to stay relevant as long as the global trade remains an important factor in the economies, and that companies rely on equity sales to raise funds to finance their operations. In the short term, the S&P will have to weather the next 24 months before we can really determine if the market corrections are completed and if more significant investments are going to be required, or rather committed. Of course, we're not required to do anything. Given the state of the world economy, the alignment of the planets, and the hints left behind by the short and the long-term price actions, I believe that it would be better to wait for a few months before finding an entry to own more shares of SPY. This ETF is highly dependent on the market trends and macroeconomic cycles. It's actually an integral part of the macroeconomic trends. So far the timing isn't that right for further investment in equities just yet. The total allocation for SPY should be between, I would say, 10 to 20% of your portfolio.